Thank you very much. Don't mind just a few corrections. I'm in North Carolina, University of North Carolina. I usually put my middle name in there because occasionally I get confused with someone else who is also, I understand, part of this society. I think it's about a month ago, I got an invitation from the Prime Minister of Portugal. It was a generous offer, but I forwarded the email. I was told that, to prepare my slides for today, I was told that the audience would primarily be graduate students in the dissertation stage. And I knew that the time that people spend in grad school has drifted, but I didn't know it was that bad. So now let's get a bit more serious. So I'm going to talk about volatility, of course, and it's volatility from high-frequency data. It's not going to be one specific paper. It's going to be like 10 different papers. So it's going to go a lot and not in great depth, but hopefully enough to get a flavor of the things. And of course, it's based on collaboration with a lot of co-authors. So they will be listed as we go along. Too many to mention in the beginning here. So this is what high-frequency data looks like, or what it used to look like back in 2000. You can see a bunch of dots there. Nowadays, it looks similarly, except that there are a lot more dots there, and there are a lot more things to take care of. Okay, so we'll get back to all this. This is the outline of the talk. I'll first talk about the development in how to estimate volatility from high-frequency data, and also motivate, why are we doing this? There are going to be some applications already there early on. And then I will talk about issues that came up because high-frequency data are great. There are lots of them, there's a lot of information, but they're also influenced by various things that either can be labeled as microstructure noise or some other for body of the academic literature. That's of the interesting parts. But if you want to estimate volatility, it's the annoying part. And so we're going to talk about how we can overcome that, or the ranks of estimators that set out to address that. Then another place where these readers measures have found a lot of use, and very good use, is in volatility models. So dynamic models of volatility, how do we model the dynamic properties of volatility? And of course, gas models have been around for a long time, so I'll just remind you what that is in the simplest way I could. And then we going to talk about how we can incorporate realized measure volatility in these models, and see ranks of applications of that. So I'm going to talk about some models that I've spent a lot of time on, which are the realized gas models. First we did some univariate, and we've done multivariate, and we are still doing variations of that. And I'll show you more applications, including something to do with asset pricing, or in fact option pricing as well. All right. So I actually don't know where the slides come from. One of my co-authors used it once. So maybe he did it, or maybe he took it from somewhere. But it's basically the frequency of data that are being used in empirical research. You have studies with annual data, quarterly data, monthly data, down to maybe weekly data. You see a lot of macro papers in that. Then you have the time series papers in finance applications, and they will go down to a higher frequency, all the way down to 1 minute data. And then there's all the stuff that happens over to the right here, which is high frequency data. And what changes at some point is that you go from having equally spaced data to having the time duration between them might not be even. And that causes issues as well. So where I'm going to be is going to be all the way to the far right. It's about maybe second data and tick data, so things that might be even tidally spaced, not evenly spaced at least. So what do we do when we want to estimate volatility from high frequency data? Well, you define the period over which you want the volatility. That could be a trading day. And then you chop it into finite intervals. And here I've divided into n sub-intervals. So you have T0, that is the one endpoint, and then you have Tn, that's the other endpoint. And in between you have a lot of times where you go and measure the price, or you measure whatever variable you're observing. And then for each of these sub-intervals, you go and you measure the return. And those are what if we're talking about a day, we'll call those intraday returns. And you can choose how many you want, depending on how rich the data are. So if you're working with the liquid stocks, then you can sample every second, and even more frequently. If you're working with small cap stocks, you often run into issues where you might not even be able to measure them every hour because they're not traded enough. So there's a big difference on what you can do depending on the data. Now what you can see from this slide is that the return from the beginning of the day till the end of the day, or the beginning of the period or to the end of the period, is just the sum of all the intraday returns for that period. So if you want to measure the volatility of the full return, then we can use all these intraday returns by simply squaring them and adding them up. And that is what is known as the realized variance. That we take each of these intraday returns, we square them, we add them up, and now we have a measure of quadratic variation. It's the empirical quadratic variation, and of course it's going to differ depending on how many times we sample. Now in theory, we could get a perfect measure of the quadratic variation of the volatility if only we could sample from the efficient price, the marginal part of the prices. Things are not quite that good. So in practice, what we need to do is we can't go all the way down to the finest limit, even with the S&P 500 spider ETFs. We need to be a little bit modest and maybe sample just every 5 or 10 minutes, maybe even less, in order to avoid the effects that will pile up from market microstructure analysis. This is not new. I mean, it's been known for a while. It goes all the way back to Merton. Already back in the 80s, he was talking about how, in principle, you can get perfect measure volatility over a very small interval of time. But also acknowledge that if you actually went ahead and tried to do this, then there will be another type of effect, error, noise, what we call noise today, that will swamp the benefits of sampling too frequently. So this has been known for a while. So even when this realized variance was starting to pick up in the literature after Tim Bollerslev and Torben Andersen started using them in the late 90s, they already didn't go ahead and sample every second. They sampled every 5 minutes, every half an hour. They were fairly modest because of this issue here. Okay. Now, what are the properties? Well, here is sort of very typical setup for price process is the one that doesn't have any noise, which is that it has it starts somewhere. It has a drift component, something that's going to be relevant for volatility. And so here's the key component: is this Brownian motion that is scaled by a sigma, which could be time varying and random as well. This is a Brownian semi-martingale, and then plus a potential jump component. Now, I understand last year you learned everything about jumps, and there's a big literature on jumps also in this literature here that goes and evaluates that. I will not talk much about that. I have one slide about it. So this is the setting. So what are integrated returns like in this model here? Well, integrated returns measured over an interval that has length 1 over n will be roughly distributed like whatever sigma you started at and divided by root n, and then times an standard normal distributed random variable. Abstracting for chunks. This is roughly what's going to happen. So that means that integrated returns will roughly have this normal distribution there. So you can see what's going to happen is that if you take all these guys, square them, and add them up, you're going to be estimating the sum of all these sigmas, and basically you're going to get an estimate of the average volatility over the day. The volatility doesn't have to be constant. It doesn't have to be non-random. If it's a random, you're going to get an estimate of this random variable, this integral of a random process, which I'll define as hidden. And now, I have to be honest here and say, this is not precisely true, especially if this guy is random. There are qualifications, but it gets more technical once you get to that. I will make them at some point when I need to. Brownian motion, I think in this audience I don't have to define that probably, but it starts at 0, it moves around in an unpredictable manner with normally distributed increments. So here are the key variables that we define from the Brownian component of the martingale. So there's something known as integrated variance. So that is exactly the average variance over this interval of time that you're interested in. So that could be a trading day, it could be less. I'll show you applications where we look at something that is just half an hour. And there's a related object, which is the integrated quarticity, which was introduced by Van der Knoten and Shepard. This is interesting because it tells us something about how precise or how imprecise we can measure the other guy. It shows up in the asymptotic distributions as a component of the asymptotic variance. So this is a variable we might be interested in estimating, and this asymptotic variance is going to relate to this guy here, which is stated here. So just from this distribution of integer returns, this description of how things they're roughly normally distributed with some variance, it's very easy to see why, at least in that case, that the realized variance is a consistent estimator of the integrated variance. If you assume constant volatility, then you can go in and you can just apply the standard law of large numbers, and it's obvious. It's very easy to see because you can write the realized variance as a sum of ID random variables. For the same reason, you can also apply a standard CLT, and you'll see why the estimate of this realized variance is in fact converging to the integrated variance in a way that the asymptotic distribution is approximately normal. And that has been used a lot. Now, this is where you see the integrated quarticity showing up. So the precision is defined as 2 times the integrated quarticity. So that's why that's an important object to define in this work here. Now, once you have that, you can also apply delta methods in transformations. And the reason I'm emphasizing this point is because this thing here is actually something that is far more useful in practice, to do a transformation first, because we're basically trying to write something up with something that is strictly positive. So using an asymmetric distribution is not going to work as well in finite samples as this approximation down here that is the same in many ways. You have normal distribution you have to do. Now, I haven't written D here. I've written this LS. It stands for law stable. And that is, again, because we're a little bit out of the sort of standard econometrics setup. We are in a world where the information, the asymptotic variance, might be random. So it's not like we have a fixed variance in the end. It's a random object. So both what we're estimating is random, our estimator is random, and the precision by which we estimate things is also random. Now the latter, those of you who are familiar with unit roots, know that the Fuller distribution is different from a normal and has something to do with the X prime X matrix being random. Sometimes you get a sample that has a lot of information. Sometimes you get a sample that has very little information. Especially that the asymptotic variance is random as well. This is the same thing that's showing up here. And when people say law stable, what they really mean and what they really want to use it for is the fact that if you have a consistent estimator like this, then you can sort of ignore that it's random. You can divide by it on both sides, and you can take the square root of that and put it under there, and you'll have something that is normal 0, 1. That's what we want to do because that's how we're going to use it. If we are in the special case where volatility is constant, then the integrated variance and the squared is equal to the integrated quantity. And so then this term cancels out, and we get something that doesn't have any nuisance parameter. So here is how we use that. How would we go ahead and use these asymptotic results? So we get an estimator. I just realized I was told to do this. So how would we actually use this? We would we get an estimator, and what we know from the extension limit theorem is that it's approximately normally distributed around what the value we seek. And then we have an asymptotic variance there. So this, I'm reading it up in the special case where volatility is constant, just to make everything simple and more accurate. So this is how we construct confidence interval. We will take the point estimate we have, and then we will do plus minus 1.96 times the square root of that. So this is how we construct a confidence interval based on that CLT there. Now there's one complication we have to overcome. It's a little bit odd that we're trying to estimate sigma squared, but in order to say how precisely we estimate it, we need to know what the value is, because it's also showing up in the variance. Right? But we can get around that, at least asymptotically, by plugging in an estimator, and the squared estimator of IB is going to be the same as the IQ. That's one way to go about it. It will be justified asymptotically, but in finite samples, it's not ideal. That's where the log transform, doing transformations is often very useful. So here is the log transform. It's known as the variance stabilizing transformation, because what happens over here does not depend on the level of the variance. Asymptotic variance does not depend on the level. We get this much cleaner result, and so we want to construct a confidence interval based on this essentially the theorem that led to this. We'll just do the log real variance, and we'll get plus minus 1.96 times that. And of course, if we want to do something that's compared with that, then we take the two endpoints of that confidence interval, and we take the exponential of that, and then we have something that is relevant for our, for the IV we're after. Okay? So that will become asymmetric, unlike the first one, which is symmetric around our estimator. This one here will give us something that is asymmetric. And that comes with making use of the fact that we're doing something strictly positive, so we don't want to go as far down as we go up, as a matter of fact. All right. What about jumps? What happens in the jumps in this world? Well, if there are jumps, here's one way to model it, that we say that the jump component is these random arrivals, and C is counting how many jumps have happened, and the jumps themselves are called DI. And they have also drawn from some random distribution that we will specify. If we are in this world, then the realized variance will actually give us the integrated variance still, but we first have to subtract the jumps. And there are ways to go out and identify jumps and figure out which part is jump and which part is continuous volatility. All right. So as I said early on, this literature using realized measures, first the realized variance, was kicked off by a paper by Anderson and Volatility that was basically responding to literature that has said Gauss models are no good because, look, I estimated the volatility of this Gauss model, and then I regress squared returns on the conditional variance for this model, and my R square is 0.05. Right? And we know in finance, if you get an R square, at that level, it's not too bad, right? But this was suddenly seen as very bad. But of course, it was because the squared returns is a really, really noisy measure of volatility. So we should not expect big R-squares. And this is what they did. They said, well, by the way, we don't have to use squared returns. We can go out, we can get this realized measure. That will give us a good measure of what the volatility actually is. Let's run the regression with realized variance on the conditional variance produced by the GARS model. And then we can work out, the theoretical limit for the R-square is 0.48 or something like that, and that's what we found. That was a good paper. And that sort of said, like, oh yeah, that these realized measures, maybe we can use it for something. And realized measures have been used in many places. I think you also had Nick Bloom here, my former colleague, at an earlier conference. Perhaps he was talking about uncertainty shock. He probably did. They have been used in the literature to sort of study what kind of macro announcement matters, both in equity markets and in exchange rates. Several papers, I've just listed one here. And then in a recent paper, working paper that I'm writing with various co-authors, we estimate a model that I'm going to present later, but then we went in and used that to identify the biggest volatility shocks that occurred during the financial crisis. And then we used those to go and see, what really sparked these shocks. I'm just going to show you two slides from that paper. This is the day that had the largest volatility shock during a 3-year period around the financial crisis. And it's before the crisis has set in. It's a day where volatility, something happened on this day that caused volatility to jump by 128.6%. And what you see here are estimates of the realized variance for every half an hour. So we're computing the realized variance for every half an hour. So you can see, I have no confidence intervals in these, but these are just point estimates. You can see this is like a normal day, nothing much happens, and then suddenly everything goes crazy. Now, I've been working on this working paper for a while, and it's very different now from where we started, because early on, we didn't look at these data. We just estimated the realized measures and used it in a model to identify the shocks. And then we went and looked for news. And so one of my co-authors had found that there was some story about Freddie Mac that had announced that they were going to tighten their requirements for underwriting loans. And basically they were no longer going to underwrite loans that where you knew that the application was full of false information. So maybe that's the reason. Maybe that was what, maybe this is the early sign of the crisis coming. But then you look closer and it was just an announcement that this is something we're going to do in the future. We're still going to underwrite these loans for a long time, 3 months, which sounds odd today, but it's what they did. That's it. And then I looked closer myself, so there was a crash in China the day before. So I got a little frustrated. Why didn't you find that? That must be the story. A big crash in China, 8.8% decline. There was also something about a suicide bomb near Cheney in Afghanistan. There were many things happening that day. It was only when we got these data, the high frequency data, we realized that all these stories could not be completely irrelevant. It was all happening over here. And so the announcement for Freddie Mac was over here around 11 o'clock. China had already happened. Suicide bomb in Afghanistan had already happened before the market opened, and things were quiet. This is where things happened. And it turns out there was basically a computer glitch that had caused prices to be stale. So there was a lot of extra volume, so I don't know why that happened. But there was basically this computer was choking and was not releasing the prices fast enough. And so they switched from the main computer to a backup computer, and then prices caught up. So they started releasing all the things that had happened, that had been clocked up, and then they stirred the market because suddenly there was all this happening, these price movements, and so it had an endogenous effect that lasted for the rest of the afternoon. So it's not the flash crash, but it's something like that. Since we're here in the Federal Reserve Bank, this is not the second biggest, but the third biggest volatility shock. And it's a day where it also starts quiet, and then you have this flip here. There are also many stories this day, but clearly it's one of the typical stories. We know that there's an FOMC meeting, and they do something that wasn't quite expected. So it was expected that the Fed funds rate would be cut by 0.5 point, but they only cut it by 1 point. And then this happened after. So we have looked at all these the largest shocks. We have tried to identify this. And then we also looked at the shocks where things went the other way, what calmed the markets. And that's quite interesting too, that almost all the shocks that brought volatility down were government interventions. It was central banks getting together and making a statement during the crisis. And now we got things under control. And now we're going to provide a lot of liquidity. We're going to lend to each other. This is the kind of thing that brought the volatility down. All right. Now, I showed you this slide before at the beginning, high-frequency data, but these are actually not all the data. These are clean data. And when you go to the data and flip further back, you see there's some new dots showing up. And I'm just pulling these for one particular day, but you have these outliers. And there are many reasons why you have these outliers. They make no sense that someone would actually do that transaction because they're typically way outside the bid-ask spread. So, is that a question? No? So, this is just one example, but we really, should also imagine that maybe every price we see is noisy to some extent, maybe with a smaller level of noise. And so this seems to be a better model or description of what high-frequency data are like. It's something we don't have to worry about when we do daily data. But when we move to high-frequency data, the highest frequency, we really have to view the prices we see as the efficient price we wish we had, this Browning's in the martingale, plus something else, plus noise. And this noise arises from many sources. Market being out of balance, so the martingale margin conditions are not quite satisfied. We have misrecordings. That was a bigger problem in the past, but we basically had prices recorded with the wrong price stamp. That creates an error. And you had prices that were zero. So people who traded at the zero price, and you figure that must be wrong. There was another error that is pretty easy to spot. That is, you have transactions that occur by a factor of 10 away from all your neighboring prices. So you just know that someone, either lost a lot of money or maybe it's just a data recording error. But then there's a smaller one, and it's just prices are confined to a grid. You cannot trade at square root 2. You cannot go and pay that price for security. You're confined to trading at, it used to be in 8th and 16th, and now it's a cent for most securities. It's the minimum price change we have in terms of quota prices. So they live on a grid, and that means that if our model says that it's a continuous in martingale, well, it doesn't really conform with prices jumping on a grid. And so every price is probably a little bit off as well. So what happens then? What happens to the realized variance if you do that? Well, the returns we see, the intraday returns we see, are going to be the returns we wish we had, plus the increments in the noise. And so when we do the realized variance, we're squaring these guys, we're adding them up. So what are we doing? Well, we're squaring the thing up we want, we're squaring the noise increments up, and then we have like 2 times the cross products. So the realized variance we can compute in practice is going to be the guy we want, and then the one with this bracket here is the stuff we wish, that we don't like. We wish weren't there, but it's there. And the first guy is strictly positive, right? It's the sum of squares. The second guy can be positive and negative, depending on whether, if the noise is endogenous, meaning that price increments are correlated with increments in the noise, then this guy would be non-zero. And it's something we see in practice. In particular, if you sample prices from mid-quotes, then there's a strong negative correlation in these guys. We know that mid-quotes are sort of smoothing the price out more than can be explained by the model. So here you have what transaction prices. Now we are zooming forward to 2007, So on the left you have, it's the same stock, still General Electric. You have all the price changes that you see over the day, actually. It's the full day. And so you see how they all live in this grid, one plus minus a couple of cents. The mid-quotes are a little finer because mid-quotes can, be at the half-cent marks as well. And so this is what they look like. And what you see down here is the autocorrelation, except that I left out the first one. So if you do transaction data, then the first order correlation is minus 23%. Very significant. Very significant correlation. Now, if prices were unpredictable, it should be zero, or close to zero. But it's not. It's hugely significant. And even the second order is significant. Similarly, if you go to mid-quotes, you see 0.08. It's very significant, the first order correlation, and so is the second one. What you have on the far right is kind of irrelevant. But you do see some noise in these data. This is for really liquid stuff. So definitely, we cannot pretend that the prices we sample are drawn from a single martingale because they simply do not behave in that way. We would severely overestimate the volatility if we use transaction data to compute the realized variance at the highest frequency, and we would severely underestimate the volatility if we used mid-quotes. And of course, these are two proxies for the same thing. So the quadratic relation of one ought to be the quadratic relation of the other if they were measuring the same thing, and you see two very, very different answers. So there was a big literature. So after the realized variance had kicked on, we were sort of trying to push the limit. How can we make use of these data? So we can go down to 5 minutes sampling, but what about all these data in between? How can we make use of those? And so there's literature kicking up in 2002, around that time, that really set out to try and do that. It turned out that there had been a guy around who's done a lot of it already. Someone who has been working exactly with estimating the quadratic relation from high frequency data. But he was the only one doing it. Bin Chu, he was a Sloan at MIT. And he published a couple of papers. It's not easy for him. One came out in JBS, and the other one came out with a book that he was editing himself. But it's actually really good work. Once you read it, and when we discovered it and saw it, it was interesting to see. So it sort of started with the first sort of very good solid estimator was by Zhang, Wickler, and Eitzer-Harlayer, Chicago guys, the first two at least, which was basically saying, let us combine two realized variances. So there's the effect of noise. Maybe we can use two to cancel each other. And there are ways to go about that if you have IID noise. So that's known as the two-scale estimator. I'm writing about it, and I'll explain in a minute why. Then there was a further development that sort of said, let us not just use two, let's use many realized variances. Some realized variances sampled at different frequencies. So some sample at the highest frequency, and some sample every 5 minutes, maybe. And so Lan Xiang was sampling at many frequencies, put them together, and proposing something there as well. And the first version of her paper was written together at the same time as we were working with the realized kernels, which takes a different route. It takes the realized variance, and then it takes all these autocovariances and tries to combine that, basically doing what we've been doing in time series for a long time, where we have been using hack estimators, estimators long-run variance. A lot of that literature could be recycled here, except that we're not dividing by sample sizes. We're doing infill asymptotics rather than asymptotics that spans over many observations in time. That's that paper. But there are many other estimators. You can try and estimate an armor model to the data, a moving average MA model, and try and use that to clean up. Basically, you can use that to figure out what's the long-run variance and use that as an estimator. There's a pre-average estimator that takes the noisy data, and then it first takes local averages, and then it uses those as roughly noise-free price points and compute the realized variance of those. You can also take the fact that prices live on a grid. And then you can say, well, let me try and model that, because I know all these increments are multiples of the tick size. I can model the dynamic in a Markov chain model. So I see all these prices moving around with these increments. Then I can extract the marginal component from that and then compute the realized variance of the filter price. There's an approach to that I wrote developed with a student at Stanford. Now, many of these are very closely related. You know, the two-scale, multi-scale realized kernel and the pre-averaging, they are just different approaches to the same estimator. And so, in fact, the two-scale estimator is really the same as a Bartle kernel in the kernel estimator world. The multi-scale is a cubic kernel using a different kernel function. And the pre-average is the Parsons kernel. So now I'm going to tell you what these kernel estimators are, and you know, very briefly. So here we have all these integer returns. Instead of just computing the sum of squared returns, we can do neighboring returns, and we can multiply those with each other. You know, this estimator has also been used where you take absolute values as the bipower estimator. But without that, we just get also covariances, except we're not dividing by n, we're doing infinite asymptotics, so this will converge to something. If there was no noise, it will converge to 0. It doesn't quite converge to that. If you set h to 0, you get the realized variance. Now, actually, one of the estimators that Xu had proposed in the JBS paper was exactly one where he took the realized variance and then he bias corrected it using the first order covariance. So this is a bias correction if there's IID noise. Then he did that. But you can actually do better. And so I'm going to show you what happens under this IID noise and give you some intuition for why does kernel estimators in general work? All these hack estimators. What is it that make them work? So there's a covariance structure. When you take the variance, first order covariance, second order covariance, and so forth, there's a whole covariance structure. And that depends on what the underlying process is and what the noise around it is. So under ID noise, it really has three terms. It has something that relates to the original process. And then it has something that's just purely noise, and then it has something that comes from the cross terms. The fact that there's a u times a y. Now, instead of just using these two guys, we could say, well, why don't we include part of the second order covariance? And that's what we're going to do in the next slide. Let me just say, there's something a little bit odd here, right? I'm doing xj minus 1 and xj plus 1. And, you know, you can sort of think of it being, they are almost the same when you do these two things. It goes back to Xu here. That these two guys are almost the same, except for the very first part of the sum and the very last part of the sum. And the reason you actually have to do this is have to do with end effects. So there's some annoying things happening at the beginning of end. And we want to get rid of this noise. In the standard time series, we don't have to worry about that because we divide by n. But in this infill asymptotics, you know, you need to be a little careful with that. Theory could abstract from that. It's technical annoyance. Anyway, so here you have these terms. This is the variance of the noise. So this is omega squared is the variance of the noise. That's the level of noise that they put on top of the efficient price. So here you have Xu's estimator. It has this variance here. And so there are three terms. There's the one that we get if we just had the pure process. There's the one if we just applied it to the noise. And then the two cross terms. Well, let's try and add this last guy. It's going to be a noisy estimate of 0. And say, you know, why the heck would you add a noisy estimate of 0? Well, you might want to do that if it's correlated with the noise you already have. If there's any covariance between that, then you can exploit that covariance to lower the joint variance. So whenever you have a noisy estimate of 0 that is correlated with the sampling error you already have, you can come up with a better estimator. This is the same principle. Why is the maximum likelihood efficient in a classical setup? Well, it's because that, you know, any other estimator is equal to the noise it has and so more. Okay. So we can do this scale here. We can try and solve what would the optimal value of A be, and you solve that, and it comes up to being a half. And then you get this variance, and you say, well, let me add another one. Let me add the third order covariance, and then you get this. And what happens is, as you do this, you're trying to minimize this guy here, the one from the noise. And why are you doing that? Well, because it grows with n. So the more data you have, in principle, the worse is the asymptotic variance. Right? But by increasing the number of lags you include, so capital H is the number of lags, you can actually expand that fast enough so that this ratio here goes to 0 faster than n grows. It turns out that the number of terms you should include should be proportional to the square root of n. And then you can make that guy go to 0 fast enough. Now, there's another guy that is going to go off, it's going to grow. And so you're balancing all these up to each other. And so the question is, which weight should you put on all these covariances? And how many should you include? And asymptotic variance will tell you that, to come up with that problem. So let's include all of them. We can compute them all, and some of them we are going to be 0 because we don't have data far enough apart. But then we do a kernel function weight. This is, if you know the Bartle kernel, Parson kernel, Andrews quadratic spectral kernel estimator, they all look like this, except that they are divided by a sample size usually. It turned out, after a lot of work, that the optimal kernel in this framework looks like this. It's a new kernel that is not showing up in the traditional time series literature. In this specific context, this is the best one. And we have, this is how you should choose how many, what this H should be, the bandwidth parameter. So you go ahead and do that. And this was a long work, Here you see sort of some of the popular kernels that are out there in the literature. And here's the QS kernel that is optimal in the setting that Andrews was looking at in time series. But we get the green one. That's what it looks like here. Does it help? Yes, it does. So, otherwise we wouldn't have been talking about this for 10 minutes, right? So here you see all the estimates over a whole month, where you have the realized variance. So the black dot is the realized variance estimator, and then you have the confidence interval based on the realized variance, where you sample modestly enough that noise is not an issue. So they're wide. Even though we have a lot of data, they're not perfect measure of volatility. What you get with the realized kernel is the blue dot, and then you get that confidence interval you see there. And hopefully you can see they're based on the log transform, so they're a little bit longer above than below. That's one thing. So you see you get an improvement, but that's good news. But there's also another thing, and that is we don't get perfect measure of volatility. So even after you've gotten these estimates of volatility out, you cannot treat them as the true measure of volatility. We're not that lucky, even though we have a lot of data. And so I have yet to see, even with millisecond data, I have yet to see point estimates that reliably give you confidence intervals that are smaller than 10% of the point estimate. So have that in mind. A lot of people building models and doing analysis based on time series of these things. Every estimate has a substantial amount of noise, and the model better accommodate that. So like long memory is great, but there is an MA component that is usually left out of these models that are important. So here are just daily estimates based on the realized kernel over the financial crisis, and so you see this persistent volatility. Sometimes volatility is high, sometimes it's low. We had a tranquil period here, and then we had a longer period where things were not so quiet. And there are many boosts, and you can put labels on what happened when in that regard. And this is basically leading up to the next part of my talk, which is talking about volatility models. So now we're going to go and make use of these realized measures by sticking them into Gauss models. First, I have to tell you what a Gauss model is. So Gauss models, for those of you who don't know it, basically has 3 components, of which only one is the main one. So it's a model that defines something for the conditional mean of returns. So RT is now a return, is a daily return, and So in the model, there's somehow a formulation of what that sky is. What is the expected return given what we know today? Then the key object is HT. That's the conditional variance. What is the conditional variance of returns given what we know today? And then there is return minus conditional mean divided by the square root of conditional variance. That's something that is studentized, right? Standardized. It has mean 0 and variance 1 by definition. And then a model will specify distribution for that. And the default is normal distribution, but there's been many variations tried. There's T-guards and other things as well. Those are the components. Now, if you go and search on gas models, you will find, 80 papers, with different acronyms. So you have ARCH, and then you have some letters, random variations, before and after ARCH. And that's because the people choose different functions, different specifications for HT. That's the original ARCH, the GARS, or zero that, and then there's a slew of models out there. Now I'm gonna want to show you for gas models. I'm just gonna assume this means to be 0. Usually it's taken to be constant, or maybe it's modeling some risk premium as well. You see that as well. But to make the slides easy, I'm just gonna set that to 0. Now to model conditional variance, what do you need to do? Well, to model any conditional moment, what do you need to do? Well, if you want to model something like that, then what you have to come up with is a function and what variables you're going to stick in there. That's what a model entails of a conditional moment. So you have to pick variables from this sigma field that you condition on, and then you have to choose a specification, maybe an unknown parameter and other things. And exactly what Rob Engel had seen was that big square, big movements are typically followed by big movements. So Rob Engels, that set all this literature in motion, was a simple ARCH model that said that, okay, I just see, in the finance world, these big square returns are typically followed by big square returns. Let me try this. So this is specifying that the function looks like this, and the return is this guy. And, appropriate for the theme of this conference, this workshop, macro finance. This was applied to macro in the first paper. It's a terrible model, and it's not a particularly good application, but what followed was pretty useful and had a significant impact. It's not very good in finance because it can't capture the persistence we see. That came shortly with Rob's student, Tim Butler's lab, who just said, well, let's add the lag variable of volatility itself. Let me redefine, what this function is and what I put in there to be this. And there you have it. You have the GARS 1-1. And it's a very simple model because you can easily work out that it implies that the conditional variance is an AR1 model. So it's very easy to work with and understand what the dynamic is like. It's AR1. It has heteroscedastic innovations, but that's also squared returns themselves are ARMA 1-1. So that's another nice simple thing that we know a lot about. And you can easily estimate these models by maximum likelihood. You just write down the distribution for returns, condition on what happened yesterday, and then you have all the parameters and how to fit in. Of course, it's not going to be these squares, but it's simple. Here's the likelihood function for this very simple model. If you take a Gaussian specification for the errors, and so you have these three parameters. HT, is moving around. You just compute this sum. And when I teach courses, undergraduate courses, if I have GARS in the course, I have them estimated, and you can do that in Excel. It's so super simple to estimate because Excel actually has a pretty decent solver now. When I started doing this, it didn't have a good solver, but now it does. And so you write down, the likelihood terms, you add them up, and you tell them search over unknown parameters and tell it to maximize, and away it goes, and it will give you estimates of the GARS model. It won't give you standard errors and other things that you might like, but it will give you this, and it gives you a lot of hands-on to understand what's going on. It's helpful. Okay, so GARS is great, but it's not perfect, right? And we can do better. And here's one of the shortcomings of GARS. So where GARS models really fail is when there's a sudden change in volatility. If there's a rapid change in volatility, up or down, it can't follow it quickly enough. And so I'm going to demonstrate that with a simple thought experiment. Suppose the truth is something that is not really a Gauss model. It is volatility is 20% per year, and then it jumps to 40%. Something like the financial crisis, or actually less than that. You can then say, how would a Gauss model work? Well, it will have its conditional variance around 20%, or the square of 20%. And then the shock tolerance then will start catching up. It's adaptive. And we can sort of compute what is the expected path that a Gauss model will take from the former level to the new level. But before we can do that, we have to say, what are the parameters? So you can just, if when you estimate a Gauss model, you find beta to be close to 1 and alpha to be close to 0, and the sum to be close to 1. So you basically get estimates that are very close to this range here. So we take that, we can compute what is the expected path that a Gauss model will take its conditional variance in this scenario. So this is what it looks like. So we come here, suddenly volatility is now jumping. The square returns are now bigger than they were before. A factor of 4 bigger than they were before, because volatility has doubled. And so the Gauss model is seeing that, but it doesn't trust these square returns very much. The alpha is small. It knows the square returns are really noisy measure volatility. So when it sees big square return, it does adjust volatility upwards, but not very much. It needs to see a lot of big square returns in a row for a long time before it actually gets the volatility up where it is. So it is adaptive, but it's slow. Now I told you that Bolosov and Anderson made, realized variance a thing in this literature. And when they were presenting some of the first papers, Rob Engel allegedly was discussing on the paper. And the way that Rob Engel used if something is useful is by sticking it into a Gauss model and seeing if it does anything good. That's what he did. So he said, okay, I'll take a Gauss 1-1, and now I'm going to take a realized measure, this realized variance. I'm going to put this in. And he went in there believing it's not going to do anything. Gauss model is probably a true model or close to it. Why would it help? And then to his surprise, see if I have that. When you stick that in to this model here, you find alpha to be huge, big. I used to say huge, but I would say very large. So it's about 0.5, and alpha goes away. It's crowded out. Square returns does not add any information over and beyond what's already contained in the realized measure. And when you look at what happens to the log likelihood function of returns, you get a big improvement. Usually when you do like rate statistic, you get something 8, 7, 2. Here it's several hundreds, for a typical sample size. So you just get a big boost. And here's why it is. Sometimes when the volatility has changed a lot rapidly, this new model can catch up very fast. This is with gamma being 50%. So you get a model that is adaptive and adapting much faster. So, but there's a shortcoming. This is a Gauss X model. X stands for exogenous. So you just stuck something in there, but you haven't modeled it. So you only have a model for returns tomorrow. You don't have anything that says what's going to happen 2 days from now. Because 2 days from now, you would need to say what's XC going to be tomorrow, and you don't know that yet, unless you have a model. So the question is, how do we close a model? We now have a model that's a bivariate. There's a bivariate variable in there, and we only have a model for one of them. So that's what I did with some students, also at Stanford, where our approach to the problem, there were other approaches. Our approach to the problem was to say, well, this realized measure is not completely detached from the Gauss model. It is basically a noisy estimator of this conditional variance. Well, not noisy. It's an ex post measurement, whereas the conditional variance is an ex ante measurement, and then the realized measure also has some noise, some sampling error. So let's specify a measurement equation, something that we're also very accustomed to in other models. And when you estimate this model here, you will get psi to be 0 and phi to be 1. Or if things are, well, I'll tell you. So there's this error here we have to think about. And also we spend a lot of time sort of coming up with a way to get a good specification for that. Something that was useful and could be analyzed, estimated easily. So it turned out, in the end of the day, what you take is the student size returns. Remember, this is the shock to returns after you normalized it. So in standard deviations, unit of standard deviation, shock. So you squeeze in this, what we call a leverage function, that basically allows for some asymmetry that negative shocks to returns can have an impact on volatility that might be different from positive shocks of the same magnitude. Not necessarily linear. Maybe I should show you that. This is what comes out of that leverage function. When you estimate it with something like an index, the ETF for the S&P 500, the spider, then you estimate this here that says that if there is 2 standard deviation negative shock to returns, then volatility is expected to go up by about 13%. If returns go up by 2 standard deviations, then volatility goes up by about 5%. And then because things have to be on average 0, it's sometimes dampening volatility. That's for the index. For individual stocks, there's less asymmetry, but it's still there. If I could summarize, this realized gas model in a single slide, it is that, it's actually very easy to estimate. You can also do this in Excel, as a matter of fact. This is like the benchmark of something being easier. There's a threshold. Excel is easy. You don't need sophisticated estimation methods if you can do it in an Excel sheet. It allows for this capturing this dependence between return shocks and volatility shocks that's really important empirically. And it can generate skewness and kurtosis in returns that we also see in practice. You get this big boost of our gas models. And another important aspect is, can we analyze these models? Can we work out the likelihood? Asymptotic normality, consistency, and things like that. And that turns out to be tractable as well. And also, again, we preserve this armor structure that the gas model has. And it carries over to the realized measure as well. So if you want to do forecasting and things with these models, there's a nice structure to rely on. So here's what a typically estimated model would look like, again, for the S&P 500 or the spider. So the gas equation looks like this. So you don't need square returns anymore. If you squeeze this in, you get that the realized measure has a coefficient of 0.87. That is to be compared with 0.05 for square returns. It's not quite fair because I only have a realized measure over 6.5 hours per day, right? And I'm modeling close to close returns like you would in a gas model. So this is partly scaled up because X is a little too small. How much too small is it? Well, that is what you can see down here in the measurement equation. The intercept is estimated to be 0, and then this slope coefficient here is estimated to be 0.74. This tells us that of daily volatility, 75% of daily volatility takes place during the hours that you have high frequency data, where the market is open. Just 26% is what's happening overnight. So this coefficient, if you were modeling open to close returns that matches the intraday period, then you get a coefficient here that's 1. And you get a coefficient up here that's 0.5. And here you can see the asymmetry that I displayed with this figure before. Now, we quickly learned that this is not the kind of structure we want. This is levels. Empirically, the data much prefer that you model things in logs, because there's too much asymmetry going on with this positive variable. You can get something that is far more compatible with the assumptions, these Gaussian assumptions that you might use in the likelihood analysis, if you map things into logs first. So that is basically what we advocate empirically. Now, the log model was also proposed in the gas literature, but because you had squared returns in there, and back in the days, you often had 0 returns, and taking logs to the square for 0 is not very good in a model. So there was some reluctance to this, not nice. But we don't have that issue anymore because these real-life measures are guaranteed to be positive with probability 1. So this is what it looks like when you do things in a log model. Here we included 2 lags up here. And now you get a coefficient of 1 here. So that tells you that the amount of volatility that takes place during the market's open is proportional to daily volatility. Persistence is close to 1, as you always find. So volatility is still very persistent. This can be interpreted like an AR1 coefficient. So it's very close to 1. And leverage, this is what, when you estimate this model, you can ask, let's simulate from that model and see what kind of skewness and kurtosis just generate. And so this is skewness of cumulative returns. So here you have annual returns would have this high skewness. And again, it's something that matches empirical data. And the same is kurtosis, very similar shapes to what you find empirically. It's not a... Now something finance. So we use this model to try and price things. And to price things, you need, and be taken somewhat seriously, you need to have a pricing curve, right? So we adopted this exponential affine stochastic discount factor in the model from the literature, and we basically have return shocks, and then we have these volatility shocks. So these are the shocks to the volatility that are orthogonal to return shocks. They're called UT in this model, in the Wheeler-Scarce model. And we have mixed pricing, and what's really nice when you adopt this is that you get something that has in closed form, and be able to outperform existing benchmark using this framework. This is still a working paper, so let's see how far we take it. There are still things we can improve. We have realized, but this is one promising aspect. We have a paper published already, which option pricing is much harder in this framework. It is to get closed form expressions. But you can work with approximations. And so here we will be looking at using some of the existing Edgeworth expansion literature. And one contribution we made was to realize that what a lot of this literature calls Edgeworth expansions is not Edgeworth expansions. They're what's called Grant-Charlie expansions. And it doesn't really matter in a gas model, but it makes a huge difference once you have these 2 risk factors in there. We also have the volatility risk factor. Multivariate models. When you move on to multivariate models, then you also need multivariate measures of volatility. So that has also been developed, where you basically go and estimate realized correlations or realized covariances. And you feed those into the models as well. So there's a literature on that. The multivariate realized gas models are, because you get this you get this information about covariances, then you can actually build quite big models without having, you're not tied down with too many parameters. It stays parsimonious because you have a lot of statistics, you have a lot of data as well. You get an estimate, you get a good estimate of covariance matrix every day to sort of keep parameters in check. So there are realized correlations, and then there's that we get from the data, high frequency data, and then there is the underlying conditional correlations. And the first paper we did in that was sort of like a one factor kind of structure, where we first had a model for the market, and then you can tack on every individual asset you want. And this is very scalable, so we did this with 600 assets. Let me show you one graph from that paper. This is what the correlation is between Chevron and the spider. So one of the temperature heavy stocks, right? And you can see how much variation there is. This is I should say the blue line is the one that the model comes out with. That's the correlation, conditional correlation. And then you have the realized measures are the red ones, the noisy ones. And there's a tremendous amount of variation in these correlations. Assuming they to be constant over a short period of time. Well, it would have to be a very short period of time for that to be a valid assumption. There's a tremendous amount of variation. And these things are not moving around because our realized correlation is moving around. These are based on the likelihood. We are asking the likelihood. We want to model the covariance between this daily return and that daily return. And then we are offering, do you want to use this realized correlation to update what you believe the correlation is? And the model says, yes, please. And because you can improve the fit in that way, and then you get the blue line. This is what the corresponding beta looks like. Again, huge variation, and of course, there's a lot of things going on in the crisis. So a lot of that about that in the paper. Things you actually see. You see a big sort of contraction of all the betas right before Lehman Brothers, and then it pops out. We develop it further where we say, well, there's one factor model. There was a lot of shortcomings in that. We could see that there were things going on that we hadn't captured with shift populations. And one way to do that is to, again, we use ETFs. So we went and got ETFs in all the sectors in the economy. And then we model a core model there, and then again we go and tag everything on. That's a working paper. Then you can ask which sectors are related to one another once you control for the market. I guess I can talk. So what if you maybe remember some of these symbols. These are ETFs on different sectors, and so something that is correlated with a lot of stuff is for example, energy, that you find to be very positively correlating with the materials, which is intuitive. But very negatively correlated with consumer staples. And a lot of these things make sense when you think about what happens during crisis, how people consume and how they move the consumption around. Gas price, the price tag at the pump is high. They defer spending on durable things. So I've been fast enough. So what I'm going to talk about just in the last 2 slides here, because the rest is just references, is another working paper I'm working on that is also using high-frequency data extensively. And also we started out by, let's do a lot of stuff with volatility, let's extract the efficient price, the hidden efficient price from some securities, small cap stocks. And it has to do, I don't know if you're familiar with it, but right now there's a pilot program, there's an experiment going on that the SEC started in October last year. So the tick size has been coming down from $0.50, $0.25, 8.16, then 1 cent in 2001. For the first time, it's gone the other way. So for 1,200 stocks, small cap stocks, the SEC imposed that the minimum tick size is now 5 cents. Now that's going to do something to high frequency data. And we went into this to look at volatilities, and we learned a lot that we didn't know before about real estimations of volatility. That is, a lot of things we knew from these very liquid stocks, the top 1,000 or 900, doesn't really carry over well to the next 2,400, which is roughly how many small cap stocks you have. Because many of them are not traded every week. Well, some of them are not traded every week. Many of them are not traded every day. Like 10% will have trading days where there's no trades at all. That poses challenges. Now we set out to basically, the idea of this experiment is to see if it's going to improve market quality. And so we went and we got the data for the last quarter of 16 and looked at that. And sadly, it's not going in the direction that some may have hoped. Things do not go well. The volatility goes up. So it's a perfect experiment. These are unusual data in our world where we're dealing often with observational data. This is a controlled experiment where they first said, here are 2,400 stocks that are going to be in the program. And then at some point they announced, these 1,200 stocks are going to be in the treatment groups, and these 1,200 are going to stay put, like they were before. 1 cent tick size, 5 cent tick size. And they phased it in gradually, so you have some stocks coming in at some point and more coming in later. So you basically have a lot of variation in the data that you can use to explore, to explore what's happening. So volatility goes up also after you're controlling for the higher level of noise. Trading volume goes down. So this was supposed to help these small cap stocks to, supposedly market makers should be more happy, having these exchanges should be more happy to having these things listed because they can make a little bit more money on them. And for that reason, the hope was that it would improve market conditions for these small cap stocks so they could grow. It's actually part of the Jobs Act. It's written into as the tacked onto the Jobs Act that the SEC had to do this. I think they did this reluctantly, but nevertheless it's taking place. We heard about spreads today. Of course, spreads are going to go up, and it hurts them as well. I just have one slide from that paper, and that is showing what happened to the volume. So there are basically three different groups. So there are three different variations of the treatments of 400 share securities in each. And so before any announcement, so here you don't know which securities are going to go in and which one are not. They look similar, and dynamically there's no sort of trending difference relative to the treated groups and the control. This is the point where they announced these 1,200 stocks will be treated. And stuff starts happening. They're not treated yet, but they will be treated in the future. So there's a lot of things going on that you have to account for if you want to measure the impact of the program. There's this anticipation effect, this transition effect, where the market is doing a lot of stuff either to get out of these securities or getting into them in the positions they want before it gets more expensive to trade in them. And then the things kick in, and what happens is that all these treated groups lose a lot of volume. And there are many, many other interesting effects in this. For example, so I learned about this because one of the UNC alumni is at NASDAQ, and he told me this is going to happen. And so that's why I tried to get data on it and looked at it. And we had this working paper, I showed it to him, and then I had the chance to talk to him. And there's something that I showed him that they had not expected. And they don't know how concerned they should be about it. But what you have seen massive volume flee the regular markets. They're no longer trading these securities in the regular markets. Well, they are, but not as much. They have moved to the so-called inverted exchanges. Just because that you're forced these very high spreads on them. And you can save a little bit of money by trading at the inverted exchanges rather than the regular exchanges because of how the fee structure is. Now, what I thought about when Ravi was talking was about spreads. Spreads can be really high. What you see that this program does is it really hurts the low-priced small caps. So the stocks that are trading down below $10, they're forced, say $5, you force on a 5% tick size, you're forcing every price change to be 1%. That's weird. That's a lot. If you compare to other countries in the world, Germany, Japan, Italy, UK, you have a much more rich set of tick sizes. Dynamic, so the tick size is 1 cent, then it's half cent, it's 5 cents out there. It makes a lot more sense. So you see these small price stocks that hurt a lot, and you see the stocks that weren't traded very much before are hurt even more. So this is just another example of what you can get out of high frequency data. There's so much information there, and that is what I'm going to run up on is that this high frequency data is really a treasure trove of information about those things. I mainly focused on volatility and how we can get latest measures and use them to study various things. There's literature on macro announcement. Then there's all these models of volatility that I emphasized here. But then you can do many other things with high frequency data that are not related to volatility. That is extremely useful. So I think I'm going to end here. Actually, I should just one thing. I'm actually coming back to Chicago next week, so if you're at the Chicago booth, I'll be talking about this. Right. Questions?
You did this alternative way to measure volatility for cars, talked about that. I think you put a graph or whatever, but I want to understand, what's the half-life? In the Dodge model, the half-life of the so-called volatility shock, which is in the model, would be very unitary.
Yeah.
And usual estimate. So but when you go and do it with the realized wall, what's like the half-life of whatever you want to call it?
So it's,
Does it like pivot dramatically?
no, it's the same. So it's basically what makes the volatility shock last a long time is the persistence of the conditional variance. And in a gas model, and in a realized gas model, and any other model you bring to data, you'll get a coefficient that is 0.98 or 0.99, somewhere in that range. So if you have a shock to volatility, that's going to stay on for a long time. Now, there are models that have, what do you call them, two components, fast and short.
I know, but I know we're not enjoying different.
All right.
But so, what is the meaning of that? Why are these volatility shocks like really important?
Why the permanent?
I mean, do you have a sense of
Well,
that? What does it mean?
Well, we have, let's take a case study. Lehman Brothers. You can just see what happened in the data, right? You can find it. There was this plot where I showed you point estimates of this one here. So when volatility suddenly jumps, it stays there for quite a while. And that's an empirical fact. That's
so if I fit like your estimate to this time series, in monthly time, what would be the half-life of the volatility shock?
That requires computations.
We have such high frequencies, like for a second. Well, what does it mean? I don't know. For a month, for what?
So when I say 0.99, I'm thinking in days, right? And it's interesting to see you. That's in this world, right? You can also go out and build time series models for regular, but there's all this stuff. Is it fractionally integrated? Is it just linear root plus noise? And I think empirically it's a little hard to disentangle which of these two models gives the best description. And those have different implications.
Or some of who we are ones.
Yeah. But it's very persistent. That's sure.
So in this graph, that is your computer glitch volatility shock that happened, before the quantum crisis?
Yeah. That is February 27th in 2007.
February.
So it's before,
Well,
way before.
So
Before Bear Stearns.
That spike before the
Is this, I don't know if you can see, can I? Must be this spike here, right? So it looks so long. It looks like this. The fact that it looks long. Now, why is it the biggest shock? I forgot to qualify that. It's because that everything was pretty quiet. It's a quiet period, so 126%. It's 126%, but it's not putting things to a staggering level.
all those bigger spikes, they're not actually happening in one spike. They're built up in several shocks.
That's true, but it happened fairly quickly. So the second biggest shock is the day where Congress is voting on the first rescue plan in October 3rd or something like that. And it failed. Right? So you have this, again, look at high frequency data, there's 45 minutes that Congress is voting. But when they start voting, the expectation is it's going to pass. And then you just see these 45 minutes volatility shoot up. And market crazy.
Let me ask you another question. What is your view, or have you looked into how different are these measures of volatility, realized or estimated, realized volatility from this attempt at trying to measure uncertainty? It's like these And when I look at those plots and I look at some of the implications, they seem to be very dominated by like dimensional proportion. Are they very different? And is there some way to know offhand that you don't measure the volatility?
Which specific measure?
And there are all these papers that I think Nick has some measure of volatility, which is not financial market volatility.
Well, he's used that too.
It's allegedly more than that. I'm trying to understand how.
They usually work with different frequency. Right? But also, Bloom he was using relay variance and bipolar variation in interest rate. But data, the high frequency was data returns, and he was trying to estimate volatility, I think, over a month. I don't have an answer to that question. Here we know exactly what we're measuring, and we have a lot of data. Of course, it might not be exactly what an economist have in mind in a specific concept.
Okay, so thank you very much. We're going to have to break for dinner and drink. Thank you again very much for the